Well, welcome back to Finance Uncut. On today's episode, hyperinflation is coming. Buy gold, silver, and commodities now. This year, I've done a few videos on some claims about hyperinflation. And Professor Richard Werner just recently talked about it again, and I did this video based on his update on whether we're going to see a hyperinflation in 2023. I also did this video earlier in the year where Dr Michael Burry came out and said that we're going to experience hyperinflation as well. And then I did this video as well, inflation warning, what's better, silver or gold? And I'll put a link in the description to these three videos. If you haven't watched them, do so, because we've now got another warning from somebody else that we are likely to see a Weimer Germany style hyperinflation very soon if the trends continue. And that's economist John Williams from Shadow Stats. So what we'll do, we'll cut to a clip now. We'll come back. I'll give my analysis, share some data, and also give you an update on how I am positioning my portfolio for what I believe is an inflationary decade ahead with bouts of bear markets in different asset classes. So with that, let's cut to the clip.
Yes, it could be. What you're seeing right now in the way of what the Fed's doing and its money creation, it's still growing, expanding year over year. And again, the most liquid measure, what I call the basic M1, is up over 80% from its pre-pandemic level. You've never seen anything. As it increases here, the Fed's not about to pull back. They can't. The system's not stable. It's a very difficult and dangerous circumstance. But I think you're going to see that continue to spike. If the Fed can find a way of bringing down their money supply growth sharply, there may be a chance of containing it. But if we keep going like we're going, I'll contend that a lot of the inflation that you're seeing here is beginning to reflect that extraordinary money supply growth, and it's going to accelerate over the next 6 months. You figure there's at least a 3-4 month lead time with things. And that's so a lot of that's already in place. You're not going to see any pullback, at least for a couple of months. But if the Fed can somehow bring its money growth back under control and get back to pre-pandemic levels, one can hope they'll do that. But you have to get outside of the current circumstance before they can do that. They have to get the system stable. The system is not stable. The economy is not stable.
Lagarde says ECB has learned from history, won't tighten early. Won't or can't? Lagarde, inflation to increase further in coming months. And Jean-Claude Trichet, former president of the ECB, has warned that the global financial system requires an orderly or progressive transition to a potential changing mix of reserve currencies, while at the same time welcoming central banks' clearer focus on combating climate change. Folks, I've been sharing for quite some time that the last 40 years, the next 40 years are not going to be like the last 40 years. And that we are moving to central planning, that the whole monetary system is changing right before our eyes. Now we've got junk bonds that yield less than CPI. This is insane. This is insane. And it is caused through the manipulation of the Fed and central banks. So here we got ECB purchases versus net issuance. So this is in the ECB. So, you know, the bond market is so manipulated. Demand and supply and treasury market. So you can see the Fed treasury purchases and net issuance there, and the projected, so you got to ask yourself, do you really believe that sovereign bonds reflect the reality of inflation expectations when central banks are purchasing 100% of net issuance? People say, oh, you've got to listen to the bond market talks. But it's being manipulated by central banks. Furthermore, it's easy to settle the bond yield debate. If bond yields are reflecting the reality of inflation and real demand from investors, because that's what the deflationists or disinflationists say, that look at the bond market, it's saying that we're going to have deflation. Well, if it is, then central banks should stop purchasing sovereign bonds now. Bond portfolio managers at banks and hedge funds, they front run central banks. So there's some people out there, I won't mention their names, but they say that, look, central banks, they're not in control, they just follow the market. They're forced, the market forces their hand. Really? Or is it that the bond portfolio managers at banks and hedge funds actually front run central banks? So they know what central banks are going to do. They front run it. They leverage up to the hilt on those trades. When they profit, that's great. As they say, privatize the profits, socialize the losses. Okay, they get their bonuses and whatnot, but then when they lose on these trades, when these trades blow up, it means bailouts, which is basically subsidized by taxpayers. Taxpayers have to fund all these wealthy people, these portfolio managers at the banks and hedge funds when their trades don't go the way they want. At the end of the day, there is no, and I've said this before, the bond market is the biggest bubble out there. It's bigger than the stock market, bigger than crypto, bigger than anything else. And unfortunately, the foundation for sound economics and free markets is pricing of money, pricing of currency. And when we have no free market price discovery in corporate bonds, in junk bonds, or in government bonds anymore, we've got big problems. Low bond yields mean weak growth. And this talk about bonds, let's cut to a clip by one of my favorite economists, an Austrian economist, Daniel Lacaille.
What does the 10-year bond tell us? Actually, very little. The reality of sovereign bonds these days in developed markets is that what they're basically reflecting is that central banks will implement more quantitative easing and more liquidity injections and keep very low rates no matter what. When the yield of the sovereign bond goes below 1.2% in US Treasuries, obviously, that means that people might have a certain level of growth scare, and certainly that the improvement of the economy is not as robust and optimistic as consensus had estimated. However, very unlikely that the 10-year bond is discounting, entering into a phase of deflation, let alone that the steepening of the yield curve is showing a recession. Why? Because both the yield and the curve are being artificially depressed and artificially managed by the central bank. When the central bank purchases 100% of net issuances, we cannot say that yields or the curve are showing anything but what the central bank is going to do in about those net purchases. So basically what we are seeing today in bond markets is simply the reflection of what is an artificial managing of the curve and an artificial management of yields. What we must understand as well is that central banks are incentivizing too much risk, and therefore these type of growth scares generate ripple effects into other asset classes because the level of risk that investors take is too high. Therefore, no, a bond yield at 1.2% in the US Treasury doesn't mean that we're entering into a deflation situation. It means that the central bank is going to continue to be 100% of net issuances no matter what. But more importantly, that the risk of stagflation is not small, because the elevated levels of prices generated in the first part of the year remain sticky, even when the trend of growth moderates slightly.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
A few moments later.
However, these one-time increases in prices are likely to have only transitory effects on inflation.
Temporarily,
Transitory.
temporarily,
Transitory.
temporarily,
Transitory.
temporarily,
Transitory.
temporarily,
Transitory.
temporarily,
Transitory.
temporarily, 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 temporarily.
80,000 impressions later.
Another thing that people aren't talking about when they're looking at the whole commodity space and inflation space is we've got these left-wing governments and central planners that are pushing ESG and the end of fossil fuels and all this sort of stuff. And so what we're getting is less production. By the way, if you actually look into the so-called green energy situation, they actually need fossil fuels. Fossil fuels are needed. There's no two ways around it. The whole green energy thing, I'm not going to go into this because the tubes will probably take me down. All I'll say is go to Capital Exploits, Chris McIntosh at Capital Exploits. Read some of his work. Can't share any of his work because it's all banned on social media. He's a fund manager. Read his stuff. But basically what we're going to see is a demand in commodities at the same time while there's less development, less production in the pipeline. And so this is going to be bullish for commodities, but it's also going to be a cost for business. This is going to create higher and higher prices. It's really common sense, but people just, I don't know if people don't get it or if there's other ulterior motives. Professor Steve Hanke, buckle up for the ride of your life. Prices are on the move with Biden's excessive spending packages and the Fed's monetization of them. The consumer can expect more inflation. It's not going to be transitory. And we're seeing it around the world. Central banks are buying more and more and more of the government debt. Russell Napier, we are entering a time of financial repression. Market strategist and one of the smartest guys I know, Russell Napier, who, by the way, was a 20-year deflationist, talks about why he sees structural rising inflation coming, why central banks are impotent, and what that means for investors. Now, I'll put a link to in the description below to this article. Do yourselves a favor, follow Russell Napier, sign up to his newsletter. This guy's one of the smartest guys out there in financial markets. He really understands the plumbing of the system, of the monetary system. And so he's in that financial repression camp. Disco Inferno, the US could be headed back to 1970s style stagflation. So whether we're seeing high inflation, stagflation, or possibly hyperinflation, we're in for a world of hurt. Jeep maker splits with economists, seeing inflation clearly. So this whole talk of transitory, or is it sticky, or whatnot. As I said in a previous video, you got Wall Street, 72% of Wall Street are believing that it's transitory. However, they've got a vested interest in that story that it's transitory so that they continue getting their cheap currency and liquidity from central banks. But you've got CFOs and CEOs who are saying, no. There's higher prices, there's inflation, we're going to be passing all this on to consumers. Who do you want to believe there? Talking about sticky, US house prices and owners equivalent rent. So when you look at the CoreLogic case Schiller index, home price index, and look at the owner's equivalent rent, how that has tracked, we're going to see owner's equivalent rent rise quite a little bit, and that becomes very sticky. Very, very sticky. And Danielle DiMartino Booth talks a lot about this. And so the numbers that we're getting out from the Bureau of Labor Statistics, the BLS, maybe take that L out and just call it the BS. That's not factoring in what is really going on. So, if this chart's anything to go by, we're going to see those CPI numbers become a lot more stickier in the months and years ahead. So this chart, if you look at the 10-year yield versus the 1 month of CPI, we're at the lowest real yield since 1980. As Daniel Lacaille said before, basically these long rates drops more due to worries about a growth slowdown and more central bank liquidity than it does a fall in actual inflation. So take that as you will. And the Fed's ownership of Treasury inflated protection securities, or TIPS, it's the largest number of TIPS that they've bought in over a year. So the Fed now owns 22% of all TIPS outstanding. What does this mean? Well, it means there's a chance policymakers want to have significant control over this market in case inflation ever becomes a bigger problem. So, as I say, watch what they do, not what they say, because what they do is almost completely different to what they say. And we're seeing Treasury continue to issue more and more bonds. I mean, government deficits here in Australia are now increasing. We've locked down our economy here, and our government is now offering more and more JobKeeper and unemployment type support. Well, that's more debt. That's more debt, and who's going to buy that new debt? Well, central banks. In our case, the RBA. The RBA have committed to doing about 200% of net issuance, meaning our bond market is more manipulated than the Greek market. So this ain't going to change, and it's going to be more and more central banks that are going to monetize the government debt, the government spending. So they're going to spend and create more. So it's changed. Things have changed. You've got to see the change, and this is what the deflationists don't see. I see it. Russell Napier sees it. Things have changed. So I found this chart really interesting. Commodities to equities ratio versus inflation, or CPI. So when we look at this, chart, if we think that CPI is going to continue over the months and years ahead, that we're going to have a high inflationary decade or a stagflationary decade, or as some people are now warning, hyperinflationary decade, then based on this chart, we can expect commodities to go much, much higher. So if we do get an inflationary or stagflationary decade ahead, stocks are not going to be a good protection of inflation for us. Here is a chart, the S&P 500 adjusted for inflation throughout the 1970s. And you can see in the late 60s to the early 80s, you got smashed if you own the S&P 500, if you own the index. And by the way, the majority of retail investors today invest in passive funds, in ETFs, index funds. And so you're going to get absolutely hammered if we have an inflationary, stagflationary decade ahead. I've shared before in numerous videos that 73, 74 stock market crash where it fell 50% in nominal terms. But during that period, if you adjust it for inflation, that crashed way more than 50%. But throughout the whole decade, this chart is very, very clear that stocks as an index is not a good hedge against inflation. Now, yes, some stocks will do well, and I've shared in other videos, even when there was market crashes in this period of 1973, 74, and back in 1929, when the market crashed there, that there were some stocks that actually went up. And what were some of them? Gold stocks. So how do we play it if we think there's going to be a hyperinflationary event? Well, Dr. Michael Burry, and I know this is not Dr. Michael Burry, this is actually Christian Bale, who played Dr. Michael Burry in The Big Short. But Dr. Michael Burry researched hyperinflationary events throughout history around the world, and he found that these were the best assets to own: silver, gold, platinum, palladium, diamonds, commodities, and real estate maybe, question mark, he said. And he said that because some jurisdictions around the world during hyperinflationary periods did things to property which made it not a good investment. But for mine, how I'm playing it, because I do see an inflationary decade ahead, a stagflation. I don't see like booming economic growth. So stagflation's definitely something that I see as a real possibility of playing out. Hyperinflation, that's just kind of, I can't even comprehend that because I've never experienced it. However, I've got friends who come from that Yugoslavian region. I've got friends from Venezuela, and they tell me what it's like. And it sounds horrible, but it sounds like a movie. But as you know, I am holding a lot of physical gold and silver. Yep, physical gold and silver to me is insurance that if we do have significant inflation periods, that it will protect my purchasing power, that it will protect me. That has always been a part of my portfolio. I don't really buy and sell that. The silver I do, but the gold I don't. And I'm hoping that physical can be handed down to my kids, my grandkids, and so forth. However, I do own a lot of gold and silver miners and explorers, and that is for me where the wealth creation happens. That's where I get the 10x's and 100x's and whatnot, and I will sell those and move into other assets. Platinum, palladium, I don't own them. Diamonds, I do not understand that market at all, so I don't invest in anything I don't understand. So I'll move on from that. Commodities, so I like both soft commodities, and so one of the big assets that I am involved in is farmland. One, I'm actually looking at moving out of the city because as we get this central planning, heavy top down, I mean, we're seeing what's been happening with freedoms and liberty around the globe in the last 12 months. That's only going to get worse as central bank digital currencies and all these other things come into play. So I don't want to be living in the cities when that happens. So one, I am looking at some other positions. So I've got some investments in farmland, but I'm looking at moving out of the city myself. That's a whole nother thing. But so I love the soft commodities. Food. We're going to have a shortage of food in the years ahead. Food prices are going to soar. That's going to create a lot of social unrest around the world. So obviously that I'm bullish on. I've got positions in other commodities like zinc, nickel, cobalt, copper. I'm also heavily invested in some fossil fuels as well. So coal, it's the boogeyman of today. But I bought some coal companies at under 2 times earnings. I bought some others at 2 to 3 times earnings. These things literally print cash for me that I can then go and buy other assets. Remember in the 90s when cigarettes were the boogeyman at the time, and the McLaren Formula One team couldn't have Marlboro sponsored on their cars anymore. Well, since the 1990s, cigarettes have been the best performing stock, bar none. You can go and fact check that if you like, but that's the truth. And understanding the whole greenwash and how that works, the whole electrification of the economy, this push for ESG and all this sort of stuff, people don't really understand. Either they don't understand or they've got some other ulterior motives. I really wish I could talk about it more, but apparently I'll get banned from the tubes. But if you want, go check out Chris McIntosh, his website Capital Exploits. Sign up to his free blog, his free newsletter. He's a fund manager. He's all over this stuff, and but he's been banned on social media, so I can't even share or even talk about any of his research that he's done. But check that out. In real estate, as I said, I've been selling real estate into this crazy bull market. A lot of my investment properties I've been selling and made tremendous gains from when I bought them. One of the reasons why I'm selling is because it's not a very liquid asset. And I think that in this crazy market that it is, perhaps it's overvalued. Also, don't trust governments at the moment. And one of the easiest ways they can target people is through real estate, because it's not liquid. It's not, you can't just pick it up and move it. I still own a couple of investment properties. They are no debt, so they just cash flow, just passive income, which I use to buy other assets. So that's fantastic. But I am looking at buying my own farmland, moving out of the city, because I don't see this being a pretty decade ahead. So with this move to central planning, the embracement of socialism, Marxism, whatnot. I mean, I just want to share this book from Ludwig von Mises, The Economic Calculation in a Socialist Commonwealth, where he absolutely destroyed any notion of socialism being able to work. In fact, socialists at the time admitted that he was right. He also convinced Friedrich Hayek, definitely leaned towards that Marxist ideology when he was a young man, and so did Joseph Schumpeter and many others. And when they read this book, they were completely convinced that socialism and Marxism could not work. And we have seen throughout history everywhere where this system has failed, and we seem to be wanting to go back and experiment with this again, with our central planners, but also, a lot of young people have got a positive outlook across the West on socialism. And so I just want to highlight this book and recommend it, that if you have not read it, if you lean towards a bit of a left-wing socialist Marxist type of view, but you're open, to having those thoughts and ideas challenged, then I recommend you read this. Or if you're someone who believes in free markets and wants to educate your friends, but want a better education with better arguments in destroying the case for socialist central planning, then I recommend that you get this book. And I'll put a link in the description below where you can buy it, where you can go to the Mises Institute. I believe you can download a free ebook. But we need to share and educate and protect and get back to a free market capitalist system. We don't have that. We have cronyism, corporatism, which is probably just as bad as socialism, but there we are. Anyway, what do you guys think? If you like this video, please hit that like button. Love to see your thoughts and opinions in the comments below. Do you think we're going to have an inflationary, stagflationary, or even hyperinflationary month or years ahead? Do you think we're going to have deflation? Love to really see your thoughts and opinions in the comments below. Anyway, take care, and I'll see you again on another episode of Finance Uncut.